Yeah, that's working now. Thank you.
Where's your light?
Good evening, Param, Jajinendra Badanya. Apologies for a slight hiccup with the settings. Thank you for all joining us today. This is our last session for the time being. We've covered various areas of financial planning, ISAs, mortgages, pensions, options at retirement, as well as tax planning ideas. Today, we're going to cover inheritance tax, wills, and LPAs, lasting power of attorneys. We'll cover those in turn. When we started this, our objective was to share with you thoughts and ideas that you may have come across but not be aware of them. So we try to make them as simple as possible and give you as much information as we can so that you can take action and hopefully make some good financial planning decisions. We've always said this, whenever you're seeking advice on financial matters, always speak to a professional, whether it's legal, financial, or any other matter. It's when you're making big decisions, always seek professional advice. And it's been pleasing to see that we've had very good feedback from people. We've had emails, and when we meet people, they enjoy the sessions, and it's given them information. Some people didn't know they could do certain things. So, we've hopefully given them information so they can take action and make good decisions. So today's topics we're going to cover are basics of inheritance tax. It's a huge subject, so we're not going to be able to cover every aspect of inheritance tax. Wills, again, a very important part of our financial planning. Lasting power of attorney, some of you may not be aware of what that is, but again, we'll give you brief details on how that works, what it is, and also some ideas on how you can reduce inheritance tax. Well, inheritance tax is basically a tax that you're going to pay if you've got assets of any means. Inheritance tax is saying, this is Vinay saying, it's a death and taxes. You're not going to be able to avoid those. And sometimes both of them happen at the same time. When you die, the IHT bill comes in. With planning, hopefully you can reduce or sometimes eliminate any IHT liabilities. So our former Chancellor, Roy Jenkins, said inheritance tax is a levy on our assets, which you leave to HMRC than to your relatives. So do you hate your relatives as much as you hate the inland revenue? So I think I'll let you make up your mind on that. So it is a voluntary levy, and why leave it to the taxman when you can give it to people you want, who can make their life better and also hopefully prosper from there on. Before I go any further, I'll just now hand you over to Vinay, who's going to go through a few things about IHT.
Yeah, hi, thanks, Jayendra, everyone. Paresh, thanks for that. As Paresh just alluded to, inheritance tax is one of these taxes which unfortunately a lot of people can plan for and can not pay a lot of it or all of it with some planning. But sadly, the stats suggest that inheritance tax that's being raised in terms of revenue is actually increasing. So it sort of begs the question as to whether people are actually taking financial advice or doing something about it, or just happy to give the money to the Inland Revenue rather than to their heirs. So first of all, before we start talking about inheritance tax, we have to obviously work out how much inheritance tax you will pay. So in order to work this out, the first step is to work out if you have any liability at all. And one of the best ways to work out if you have an inheritance tax liability is to use one of the online calculators to work out the value of your estate. So basically the value of estate is things like property, cash and other possessions, from which you would then subtract away the debts or such as mortgage or any other loans, etc., that you have against it to work out the net estate value. Next slide, please. So when you do work out inheritance tax, as we've probably mentioned a few times in the past, there are certain exemptions that you are allowed to offset against the inheritance tax that you pay. The main one is the personal allowance, which is 325,000. So what that means is for the first 325,000 of your estate or your assets, you don't pay any inheritance tax on it. And you are also now allowed another 175,000 if you're passing your family home to your direct blood relatives or blood descendants. This is known as the residential nil rate band. So in total, 500,000 of your estate can be protected from inheritance tax to start with. And as it says at the bottom, if you are a married couple, then you can combine the two allowances together, which means that each of you has 500,000 of your personal assets and estate that can be protected against inheritance tax, and therefore doubled up, can be up to £1 million, provided that obviously some criteria, etc., are met. So quite a huge chunk of your estate can be protected away from inheritance tax. And as I say before, it's a case of working out how much your assets are in total, and then seeing basically whether the inheritance tax is actually payable on any of your estate. Next slide, please. So, sorry. So similarly, what we've said is that when someone is widowed, usually you can also carry forward the inheritance tax thresholds which are unused by your late spouse. So what that means is that if you've not claimed any of your inheritance tax allowances and all your assets have moved from one spouse to the other, then the surviving spouse would also be able to make use of the late spouse's allowances. You can make certain deductions, as it says there, for certain things which you may have, such as alternative investments called AIM. These are stocks in small companies, shares in small companies, which obviously is a risky sort of investment, but it's allowable. And also any debts that you have can be which haven't already been deducted, can be deducted, as it says. Next slide, please. So once you've taken all your exemptions into account and you worked out what your estate is, anything over the amount of any allowances that you're allowed, the balance would incur a tax charge of 40% on the balance, which is quite a considerable chunk. This is between spouses. There's no, the assets move between spouses. It's really a case of when the second person of the two passes away and your estate or your assets pass down to the next generation, and the Inland Revenue will request, once they've worked out how much inheritance assets you have, 40% of any balance over your allowances that are you're allowed to take. So next slide, please. So just to give you an example, just to give you some flavor of how it works, just taking an example that if you had a house worth 950,000, if you had value of cash and ISAs worth 300,000, value of shares 150,000, and also other possessions such as jewelry, clothes, all of this added together, and your total asset value, your estate value is 1.5 million. Next slide, please. What you can do is you can offset any balances that you have on your mortgage. So for example, 50,000. And as we mentioned earlier, you can offset the residential nil rate band, which is 175 times 2 for married couples, so 350,000. And your personal allowances, again, times by 2, which is 650,000 in total, giving you a net estate of 450,000, of which 40% would be liable to inheritance tax. So quite a considerable sum of 180,000 on this example would be lost to the Inland Revenue without any planning. So it can be quite a considerable tax if not planned for, as we mentioned before. And as it says there at the moment, please note that obviously tax rules change, and the benefits from personal circumstances depends on your personal circumstances rather, and the exact amount of tax you'll pay will depend on your individual circumstances. Next slide, please. So just looking at the IHT Basics, things to consider. So what we mean by that is, okay, you've already worked out your estate. What you need to think about before you start thinking about how you're going to protect your estate from inheritance tax is you need to work out obviously what you need to live on. There's no point giving away all of your assets and doing other things in terms of planning if it leaves you short in terms of what you need to live on. As we've said earlier in other presentations, people are living longer, and therefore the need to have enough assets that you can live on is becoming more and more relevant as years go by. You also need to think about if you were to pass away, if your partner would have enough assets to be able to live off. Consideration of inflation is also something worth thinking about, because as we all know, as time goes on, the value of your savings and other assets in real terms do fall when you take account of inflation, because of inflation, prices go up and everything becomes more and more expensive as things go on. Finally, I think you need to also consider the possibility and the cost of long-term care. It's always been a traditional thing where mum and dad have been taken care of in families when they get older. As we know these days, that's not necessarily the case. And a lot of people are concerned about the need or potential need for long-term care. So we just need to be aware that these sort of things are things you need to think about before you start making any plans in terms of what you do with your inheritance tax liability. I'll hand you over to Parish.
Thanks, Vinay. So a will, writing a will. The number of times that I go and see clients and ask them if they've written a will, they haven't. Just last week, I went to see a client where two brothers running a business, asked them, what about the will? Haven't set one up. We're talking about where they've got estates, maybe, £1 million, £2 million. I haven't made a will. So, making a will is a must. And I would advise everybody watching today that if you haven't made a will, please do so. And I think there's an incentive at the moment where you can make a will and for free, and you can potentially just make a gift to a charity. So, as I said, will is the foundation of your IHT planning. It allows you to decide who will get the money, when they will get the money. For instance, you've got children, you want to make sure that they get the money at a certain age if you're no longer around. And also it saves potentially paying the taxman any money. You can write your will yourself, but I would say no, don't do it yourself. There are things that people say, I'll buy it from W.H. Smith or ready-made will. But I think for such a big decision that you're going to make, always get a professional person to draft a will. They will probably charge maybe £300 to £400 for making a will. But when you're thinking of your estate, could be your house nowadays is alone £500,000 to £600,000 minimum. So and plus other assets that you may have. So why not spend that money and get that will drafted so that it's made, put in the, everything is put in place properly. Because if a badly drafted will cost you a lot more money, or your dependents a lot more money later on. So I would always advise that. So next one. So the will, again, when you do, make sure the will is witnessed by somebody who's not a beneficiary, because otherwise it will be invalid. And also, if you made a will and you need to change it, i.e., children have grown up, you want to change, or you've had more children, you could add them in what's called a codicil, making it basically an amendment to the will, adding that child onto your will, so that they're covered. So what happens if you don't make a will? Well, if you don't make a will, generally the up to £270,000, your partner, your wife, husband will get that. The rest of it, you will have what's called life interest, 50% in life interest, and the 50% remaining will be going to your children. And remember, it will be taxable. So you will, if a husband passes away without a will and they've got assets, some of the assets could be liable to IHT. So very, very important to make a will. You don't really want somebody else having assets. You ideally, your partner, you want them to have the assets, or your children. But once they, if for instance, husband passes away, wife gets 50% on the remaining assets. She may not have control of it, and if their relationship aren't very good, it could create problems. So really, will is to resolve a lot of problems that you could have. So essential to make a will. I think it mentioned the will show who's to benefit from there, and also important is if you've got children under the age of 18, who will look after them. Because if you haven't got a will, where will the children, who will look after them? And that could be an issue as well. They could become children of the ward. So it wouldn't be down to you or your relatives. It could be social services will say, well, this children will be looked after by somebody else. I think that covers my part of that. So back to Vinay.
Yeah, thanks, Paresh. So just one thing also to add to the wills conversation was that obviously if you die without making a will, then how your estate gets divided up is down to the rules of intestacy. That's what the terminology is. And basically the courts will decide who will benefit from your will in a certain order, depending on whether it's, depending on who it is. So, you definitely won't have control over who the money goes to. So just bear that in mind. So moving on. The lasting power of attorneys, basically another part of inheritance tax planning, which a lot of people sadly don't put into place. And the lasting power of attorney, along with the will, is probably the two basic elements of any sort of inheritance tax planning that people should look at. And what the lasting power of attorney does, it's effectively a legal document that you would assign or you would appoint someone to be your attorney. And the reason for doing that is in case you lose mental capacity through illness, you may not have any, you may be unable to look after yourself in other ways. And therefore, at that point, the lasting power of attorney would come into play. So we would always suggest that the donors you set up possibly could be your children, who would obviously then have a say in what happens in case you lose your mental capacity or illness or something of that happens to you. It's very important because if you don't do this, then I'll come on to the consequences of that in a minute. You have to be over 18, and when you set up a lasting power of attorney, you have to have mental capacity. What that means is that you have to be aware and of a mind that you basically are making this decision based on your own on your own needs, etc., without someone making you sign a piece of paper where you're not sure what you're signing. So just be mindful this has got to be done before the onset of any sort of mental capacity, lack of mental capacity, etc. The other point is you don't need to live in the UK or to be a British citizen to set up a lasting power of attorney. So you can be abroad and it can be used for making decisions on UK assets, etc., should that come to that point sometime in the future. Next slide. There are two types of lasting power of attorneys, and they do two different things. So one is known as health and welfare, and one is known as property and financial affairs. So you don't have to do both of them, but we would always recommend that you do both types, as they basically cover different things, which I'll go through in a minute. So just be aware that both of these type of documents are separate, cover separate things, and provide you with separate things in terms of when they come into play as well. So how to make a lasting power of attorney. So you've got to choose your attorneys. You've got to have at least one. So what we're saying is that it could be your children, it could be someone you wholeheartedly trust will look after your affairs should something happen to you. And what you need to do is there's a specific form that needs to be filled in order to appoint an attorney, and that form is available online. You have to also register the lasting power of attorneys with the Office of the Public Guardian, and this unfortunately is taking a long time, as it says there. It can take up to 20 weeks to put that into place. And with the COVID situation, everything that's happened in the last 18 months, a lot of these deadlines have gone even further out, and people aren't getting the stamped registered lasting power of attorneys back for 6, 7, 8 months. So just be mindful that these things take time to put into place, and therefore you should put them into place and do something about it as soon as possible. The longer you leave it, the chances are that if something were to happen, then if they've not been registered, they actually won't be valid. When you set up a lasting power of attorney, there is a cost of £82 that you have to pay to the public guardian to register those wills. And if you're setting up the two types of lasting power of attorney, then you have to pay two lots of £82, and that's per person. So if you're setting up a lasting power of attorneys for husband and wife, then it's £82 times by 4. There are certain exemptions that you can get. For example, if you are in receipt of government benefits, state benefits, then certain ones will allow you to get a reduction on that, or total exemption as well. So again, it's worth making sure you check it out and pay the money that you're supposed to pay for these things. Next slide, please. So just moving on to what these lasting power of attorneys do. So health and welfare, as it says here, it gives the attorney the power to make decisions about things like, for example, washing, dressing, eating, medical care, moving into a care home, life-sustaining treatment, and it can only be used when you're unable to make your own decisions, which is very important. So for example, if you are unfortunate enough to maybe have an accident or something which puts you into a coma and you're no longer able to make your own decisions, unless the health and welfare lasting power of attorney is in place, then your sons and daughters won't actually have any say in the treatment or the time to switch off the machine, etc. It will just be down to the doctors who are caring for you to make that decision on their behalf. And there has been situations where the family have wanted one thing and the doctors are saying something else, and sometimes it has actually gone to court to work out what's the right way to move forward. So at that sort of time, you really don't want to have those sort of issues faced by someone who's having to look after you in those circumstances. So just be mindful that these things are put in place to really make other people's lives easier to look after you. Next slide, please. So property and financial lasting power of attorneys, again, gives the attorneys the powers to make decisions on your money and property. So things like managing your bank account, paying your bills, collecting your benefits or pensions, selling your home, and it can be used as soon as it's registered with your permission. So it's different to the other one, the health and welfare one, which only comes into play when you lose capacity, whereas this one can be enforced as soon as you wish. So you can give the attorney to someone when you're ready, for whatever reason. So it's slightly different in that sense. And what we've also found is that, as we probably mentioned before in previous webinars we've done, something like a bank account, if you don't have a lasting power of attorney in place, then if should one of you lose mental capacity and you have a joint account, then actually the other person can't use that money or take money out of that account without actually having to go to court to get an acceptance from legal acceptance that you're allowed to use that money, as there have been cases in the past where the monies have been siphoned off for the wrong reasons, and the person who hasn't got the capacity anymore has been left high and dry. So these things are put in place to really protect you, and it's always for that reason it should be done. Next slide, please. So as I mentioned earlier, whenever you're talking about lasting power of attorneys, you need to register them with the public guardian, the Office of the Public Guardian. And here's some details of how you can contact them should you wish to. And they're quite helpful in terms of guiding you as to what you need to do, how to set things up, correct payments to make, etc. So I would suggest if you're not sure and unsure about how to basically set one up, or any questions that you have, other than obviously seeking legal advice from a professional, you can speak to the public guardian yourself and make those decisions based on what they tell you. Next slide, please. So this is basically what I was suggesting earlier on, that if you don't have an attorney that's been put in place, or you haven't appointed one, then your relatives have to apply to the court of protection if you lose the ability to make your own decisions. This can be a very slow process. It can be a very expensive process, and probably you won't be able to select your own attorney in this instance, or specify how you would like your affairs to be managed. So it's always a good idea to make sure that these lasting power of attorney is in place. Otherwise, other people will be making the decisions on your behalf, and it's possibly not the decisions that you would have wanted. Next slide, please. I'll hand over to Paresh.
Thanks, Vinay. Yeah, I think, again, really important to make the LPAs, because there are times when I come across where social services need to come into play, but the individual hasn't the mental capacity to make decisions. So it will be down to the council and the social services to make those decisions. However, if a lasting power of attorney is in place, that attorney could help make those decisions, because they could be brother, sister, daughter, son, and it makes the job a lot easier. As Vinay said, otherwise it could be quite painful, slow, and difficult. So coming on to IHT, how do we reduce IHT? Vinay's put three there: spending, gifting, investing, and the fourth one, I think, which we can put down, is gifting to charities to reduce your tax as well. So looking at the first one, spending. So ideally, best way to reduce our IHT is to spend it all, not leave it to anybody. Go on holidays and do what you enjoy. You've worked hard for it, enjoy it. And I think a lot of children that when I've seen parents, they want to leave it to the children. Rightly, they want to leave it, but some of the children said, no, enjoy the money that you have, spend it. They will make their own way in life. So that's one way. But unfortunately, people have assets, and even if you have extravagant holidays and do extravagant hobbies, you may not be able to spend it. So that's not always the ideal answer. So the next one will be to look at gifting the money that you have. So by using allowances that are available, you can gift money across over a period of time to whoever you wish, and they will be outside your estate immediately. Things like you can make an annual gift of £3,000 per individual. That will reduce slowly some of the inheritance tax that you have to pay. Potentially exempt gifts are gifts that you made, but you'd have to survive, say, 7 years before they're outside of your estate. Third one is chargeable gifts. These might sort of mean that you've gifted a certain amount to your family or anyone, and there'll be an immediate chargeable lifetime tax. So that may be payable immediately. So those are the three kind of main ways of gifting the assets to your dependents. Next slide. So again, some of the points that I covered before. So on marriage, you can give a certain amount of money to your to the wedding, the couple. Annual exemptions of £3,000. There's £250 gift allowance, small gifts. And the one that is missed out most of the time by people is extra income. So if you have extra income, you can gift that without any issues. So for instance, to give you an example, if your income is say £40,000 a year, you're spending 20,000 of that, you have that surplus of £20,000. You can spend that and give that to anybody you like, as long as it's regular. And it doesn't have to be the same amount. It can be irregular, different amounts, but on a regular occasion. Regular means monthly, annually, quarterly, biannually, every 2 years, anything of that nature, but make sure you record it in your records that you've been giving this money. So as long as you're not dipping into your capital, it's out of income. So if you've got a pension income, you've got rental income, but it's more than you need, you can give the excess away, and it's called gifts out of normal expenditure. Sorry, Vinay has mentioned charities and political parties. So Oshwal obviously is charity. So you can leave in your will money to Oshwal as a gift, and that will reduce your inheritance tax and can reduce your inheritance tax by up to 10%. So you could, instead of 40% income, your tax could go down to 36%. So it's worth looking at making those gifts. Next slide. Potentially exempt. So if you made a gift today of £100,000, and it's over and above your £1 million allowance, your estate will be chargeable to 40% tax. If it's done, if you die within 3 years, and obviously on a sliding scale, after 7 years, there's no tax to pay. So that's, again, a good way of starting to gift early in your life is better than later. Next one, please. Nikaj, next one. So some of the other ways of reducing IHT is, Vinay mentioned earlier, there are in two types of investment products. These are government approved or HMRC approved products. Business relief, i.e. if you've got a business, your assets, the value of your business is potentially outside of the estate. The other one is to invest into a business, like using the enterprise investment schemes. That will anything invested for more than 2 years will be exempt assets, so it'll be outside of your estate. So if you invested £100,000, after 2 years, it'll be outside of your estate, and as long as you remain invested at the time of death. I think that's. I may have taken one of your slides, really.
No problem at all. You were doing such a good job up until then as well. So thank you, Paresh. So just moving on, next slide, please. So there are other way of basically reducing your estate is by investing for children, something that we've mentioned in previous seminars again. Giving to your children, giving to your grandchildren is a great way. You know, it's usually a priority, high on a priority list for most people to make sure that their children, etc., are taken care of. And it can be part of the IHT planning too. So 2 ways that you can easily do this is by investing money into a junior ISA for grandchildren or children up to the age of 16. And that money can be outside your estate after the 6 years normal rules. But the great way is that you're shifting some of your money out of your estate and building up capital in your children's estates, which is a great way to move money across before it's taken into account for your estate planning purposes. Just one thing to remember on junior ISAs is that obviously that money does become legally the child's money from the age of 16, and from 18 they can make their own decisions from that point of view. So just be mindful that if you do put money into junior ISAs, you are losing certain amount of control as to what happens with that money. Obviously, we all hope our children are going to grow up and do the right thing, but you never know. So that's something to be mindful of. The other thing you can do is set up a pension for your children. Again, one we've mentioned previously as well. It's a very tax efficient and great way of getting money outside of your estate. You're allowed to put in £3,600 per annum into a pension for a child from the age of 0. And on that, you get basic rate tax relief, and it nets down to an investment of £2,880. So although 3,600 is invested, the tax relief will make up the difference of what you pay and what's actually invested. And remember, this money then can't be touched until the child gets to the ripe old age of 55. So it's one way of protecting longer term. But the great thing is that it's being invested for a long period of time, and therefore as returns on those type of investments grow over time, it can be a very lucrative way of investing. And any money that's out in the pension for your child is automatically outside of their estate, as well, as we've said previously as well. So just something to consider. Next slide, please. So just moving on to other inheritance tax opportunities. So you can put money into a trust. So the trust usually saves you tax, as we mentioned, over the longer term, and you keep control of those assets, which is also very important to many people. In order to set a trust up, you have to pick trustees. It can be including yourself, and these people could be, husband and wife, son and daughter. There could be multiple trustees on it, but these are the people, in case you're not around, who are going to make the decisions, like when and who the trust is distributed to. You can make gifts into the trust, and the normal rules apply. So if you make a gift into a trust, if you put £10,000 into a trust, then you have to outlive the 6-year rule before that's outside of your estate. The benefit, obviously, as we mentioned previously, is you stay in control, because that money is within a trust which you control, and ultimately the trustees on your behalf will make decisions in case the money is used for the wrong reasons. It can't be done that way. There are many types of trusts. The 2 main ones are discretionary trusts and bare trusts. Now, bare trusts are effectively where the beneficiaries are set up from day one and then can't be changed. So it's a very, very specific type of trust that you're setting up. So it can only be done once set up. The beneficiaries can only be the people named. It can't be changed. Whereas with the discretionary trust, as time goes on, you can add to, or you can take away beneficiaries from that trust. So it gives you a little bit more flexibility in terms of who to distribute your assets to from the trust on death, etc. Next slide, please. So there are 2 other types of trusts, one known as a loan trust, and I'll come back to the other one in a minute. A loan trust is where basically you put money into a trust, you loan the money to the trust, and the great thing is it stops your value of your trust getting any bigger. So what I mean by that is if you put £100,000 in, all the effective growth on that is outside your estate. So effectively, the only money that sits in your estate is the initial capital, and the rest of the growth over time builds up outside your estate. So it's a great way of getting money outside of your estate. You do retain control because ultimately that money you put into a loan trust is a loan. It's not a taxable loan, it is a tax-free loan, but you can reclaim or return your capital back to you at any time. It's like an IOU. So it's a great way to put money aside with the knowledge that in case you ever need the capital, you can get the capital back, whereas the growth will always be outside your estate. So it's, you know, a great way of making sure that money is passing on without any inheritance tax on it. Next slide, please. So another form of trust is known as a discounted gift trust. So with this type of trust, there are two actually. There's a gift trust and there's a discounted gift trust. And the main difference between the two is that the discounted gift trust is split up in a way that you make a gift to a trust, which you basically give up all rights to from that day on. It's not recallable like it is in the loan plan. The gift is then split into two parts. The first part is treated as a gift and will fall outside your estate as normal in 7 years. But the second part, which is the discount part, is used to provide an income to you for the rest of your life, but it's immediately outside your estate. And the amount of the discount is based on your age and your health. And the longer you're expected to live, the greater the discount is, and the larger the immediate inheritance tax saving. So rather than waiting for the full 7 years to run on that part of it, effectively from day one, you get a discount against the inheritance tax liability on that money. So it's outside your estate very, very, quickly. And the great thing is you can carry on taking an income from that for the rest of your life, but your capital is something you cannot get back again. It's a gift. And as soon as you take it back, then obviously it all unravels, and so we wouldn't want to do that. And the gift trust is another form of this where you don't get any discount on it. You just effectively put money into a trust and wait the normal 7 years for that money to be outside of your estate. So there are two different types of trust that you can do. With the second one, you don't have the right to any income and you can't touch the capital. It's purely done as a gift. Next slide, please. So I think we've mentioned pensions in the past many times as well, but you have to understand and remember that pensions generally do not form part of your estate. So it's a great way where potentially a lot of people now have enough income to live on for the rest of their lives, can save money into a pension, and that pension money can be outside their estate, because ultimately if you pass away, that money moves down to your beneficiaries. And as we've just said there, basically it doesn't have to be any particular person or it doesn't have to go down in any particular steps. You can name any beneficiaries. So potentially you could say, I want it to be my grandchildren, for example, in which case the money that comes from the pension on your death can skip a generation, which is a great way of saving inheritance tax for the middle generation, your children's generation, who may already have a lot of assets themselves, and by having more money put into them can create even more inheritance tax problems for them. All you're doing is just effectively moving it down the line. So just something to be aware of, that by age 75, if you have passed away before age 75, then your beneficiaries can draw down the money from your pension as either an income or a lump sum or a combination of the two, tax-free. So there's no further taxes to pay for them. Should you die after the age of 75, then the withdrawals are taxed as income. So depending on whether your person you're passing it down to is a basic rate taxpayer, high rate taxpayer, or an extra high rate taxpayer, will depend on how much tax they have to pay. Always be mindful with pensions. You need to be aware who you want that pension to benefit. To do that, you should always complete an expression of wish form, which basically tells the pension provider on your death who you want that money to be given to. And the expression of wish can be changed. It's not a case of it's set up once and can't be changed. So you can add beneficiaries later on, you can take beneficiaries out. So again, a little bit of flexibility from that point of view. Next slide, please. So in case you're looking for any further information, the government website, as mentioned there, has a huge amount of information on inheritance tax. And a lot of the information is very, very good and simple and easy to understand as well. So as a starting point, make sure that you visit the website and go through all the parts of that. There's a huge amount of information in there. And ultimately, if you can understand it and make some decisions on the back of that, then that's a great way to do things. And ultimately, if it gets too complicated, as we've said previously, always a good idea to basically go seek advice from a professional who can help you to guide you in the right way to make your decisions as and when you want to. So I think that's the formal part of our presentation done. Paresh, if you want to come in. Next slide, please.
Yeah, hi, thanks, Vinay. Thank you all for watching. I think this is a kind of a pretty quick cover of pretty heavy topics: inheritance tax, wills, lasting power of attorney, and ways of reducing IHT. As always, we would say that please seek advice when you're doing any kind of planning, because when planning goes wrong, it can cost you a lot of money. And I'll give you a small example. Just happened yesterday. A client had gifted, or the client's mother had gifted the property she lived in to the 3 children while she was still living there. Now, in their wisdom, they thought that this was a good idea. However, the estate is just over £1 million in total. So had they not done anything, there would be no tax. They would have benefited from the nil rate band. They would have benefited from the residence nil rate band, which is up to £1 million. So their tax would have been just on the £18,000 over the $1 million that they had. Minuscule £4,000 to £5,000 tax they would have had to pay, inheritance tax. However, because the way it was done, and the mother survived 4 years, I think. So they will end up paying around about £150,000 in tax. This is the cost of not taking advice. So always take advice. Make sure the person you're taking advice from is qualified and able to give you good advice. So again, thank you for all your questions. We've had questions on our email, oshwalweb@oshwal.org. We'll still welcome questions if you want, if you're not able to put them down on the YouTube channel, but we will take them, we'll answer them as well. So thank you very much for that. So we've covered, as I said, many things, pensions, ISAs, covered ideas about saving for the younger generation, how education and awareness, mortgages, and in life cover. I think an essential part of IHT planning as well is to have life cover in place, which again could be put in trust and be outside of your estate, using the personal allowances, which we've again covered a little bit more today, and options at retirement. So these have been good sessions. Thank you all for joining us. We're going to take some questions now. So I think Vinay, Hasit Shah is asking, what is the threshold for determining health and well-being, and the LPA can be invoked? I guess what he's saying is, when can the LPA be invoked for health and welfare? So
basically, it's a case of when you're no longer able to make your own decisions. That's the point at which the LPA would be applicable. I think that's what you mean. So it's purely got to be a loss of mental or physical capacity. I guess it's when they're not able to make their own decisions. So right. yeah. That's the official definition from the government website. I think Dina is asking, what's the difference between expression of wish and a beneficiary nomination form? I think both the same, but just different companies use different things. One thing I just wanted to say,
is that pensions, a lot of people have pension pots, husband and wife have pension pots. In order to save inheritance tax, any options on that? If one of them dies, what would your kind of thoughts be on that?
I'm not sure what you're saying.
Okay, so what we would consider as a preservation trust.
Right. Okay. Yeah, you may as well carry on explaining now.
Okay. So basically, if husband has a pot of pension of £500,000, he passes away, that £500,000 would pass to the wife. Now, in normal cases, everything passes to the wife, but what she's received is everything plus the £500,000, which could be going straight into a trust, so it would be outside her estate, therefore saving potential £200,000. And this is something called a spousal bypass trust. Again, worth looking at for people who have assets and want to reduce IHT. So worth considering. It may not be right for everybody, but something worth considering.
So there's another question here from West Green. What are the tax implications on trusts?
Right, so trust. Now, how trying to explain this in a couple of minutes is not easy. Income from trust will be taxed at your marginal rates, and there could be other ways of reducing it, but in general, that's what it will be. The trust itself would have to submit returns each year to the revenue as well. So it's a slightly complex subject to go through in a couple of minutes.
I mean, if you're thinking about this I would say to the person who's raised the question, I would definitely seek advice properly and have a proper chat around the tax implications before setting something up. There are certain limits at which you should probably set up trusts for as well, because otherwise investing a huge amount into one trust can also lead to its own liabilities. There's a lot of other things like the 10-year tax charge, etc. So there's quite a complex area to think about. And as Paresh has said, this is probably not the format or it's not the right formal sort of setting to have those sort of conversations.
Are cash gifts from surplus income exempt from IHT in addition to the annual 3,000 exemption?
Yes, they are, as long as it's out of income.
Yeah.
So as we mentioned before, if you have a £40,000 income and you only need 20,000 of that to live on, then you can gift the other £20,000 without any inheritance tax liabilities. But you have to show sort of a long-term sort of. You have to be able to sustain it, in other words, and show that you have an intention to give that money away on a regular basis.
Yeah, I mean, if you're not able to carry on, that's fine, but I think it has to be regular in nature, even if it's every other year. Yeah. So Vivek is asking, an average, how much does a trust cost to set up?
There's nothing like an average cost. These sort of things are more complex, and it depends on how complex planning you want to do. So again, it can be multiples of thousands, but you have to look at the benefit of what you're getting for that. And again, seek proper advice from a legal person, from a professional who understands trusts and can set them up. But they have come down in cost in that sense, definitely, from when they originally said, trusts were around for many years now, but they have come down in cost. But again, it really depends on where you take advice and who's setting it up for you, etc. So I wouldn't say there's anything like an average cost. And there's also a regular cost for maintaining the trust as well to be mindful of as well.
I think also not only regular costs, but making regular returns to the HMRC. And sometimes people will set up the trust and think that that's it. It's not. It's not it. There's a lot more involved. And there are trusts where people have purchased investments, like an investment bond, where your money is invested, and trust is created at the same time. So typically, a life insurance company would create a trust for you. Because it's a packaged in one product, there's not normally a charge for setting up that trust. But however, say you want to put a property into trust, you'd have to seek, go to a solicitor who would set one up for you. And as trustees could be yourself, or you could have professional trustees who do this on a regular basis. So yeah, the cost can be, depends on the firm of experts you use.
So, Harish, I think let's wrap it up.
Yeah,
From my point of view, I think I don't know if I speak for yourself, but definitely enjoyed doing these sessions. It has been a bit of hard work from both of us. Sometimes the months come around very quickly, and we found it quite a challenge sometimes to set these slides and everything up. But the great part of it is all the positive feedback we get, from my perspective, has made it all worthwhile. I'm sure Paresh would agree that.
yeah, definitely. Yeah, I think today was one day, a slight technical hitch that's kind of thrown me a bit today, but these things happen.
And you forgot to put your money in your meter once as well.
Yeah, it's the 50p's that I need to put into the meter. But yeah, no, definitely, it's been good. Hopefully, members have enjoyed it, and we hopefully will come back and do some more. But at the moment, we'll take a short break, and then we'll think of some other ideas to share with our members. But thank you all for joining, and have a good evening.
Thank you.